Hello and welcome to the investment review for April 2015, which I've done so that we can have a look at matters just ahead of next week's general election. I thought it'd be pertinent to issue an investment review at this time, being mindful of the uncertainty that a general election can create in markets. To create something of an overview before we start with any thoughts as to what the election may hold for us in respect of our investments, I thought that it would be sensible to have a look at what recent events have resulted in for all of us. Turning our attention to the markets, as most of you probably know, they have recently reached new all-time highs. The medium to long-term outlook for equity markets remains positive, and this is supported by monetary policies that many central banks around the globe continue to retain. Equity valuations continue to be attractive relative to fixed income assets, and global economic growth continues to improve. That said, there are still plenty of bumps in the road that need to be overcome in the short term, and there is every chance that we could be entering a period of increasing volatility. And so, in addressing the subject of volatility, this is something that we have become somewhat, perhaps reluctantly, accustomed to since the financial crisis of 2008. Without doubt, the volatility of markets is assisted by significant advances in information technology, with day traders being able to trade huge volumes of shares in quite literally seconds. They and their complex computer programs can react instantly to news events and adjust their positions accordingly, and in some circumstances, they can even create the news. There is an old adage that says to sell in May and go away, come back at St. Ledger's Day, and it's one that's worthy of some consideration given the expected spectre of volatility, this perhaps being exacerbated by the forthcoming events of the election. We therefore need to consider these things in the round. I've analysed 16 separate years covering the period May to September, and the analysis was across the FTSE All-Share Index. Across the periods that I analysed, on only 6 occasions would it have been beneficial to have sold one's shares and repurchased them at the end of September, and therefore on 10 occasions it would not have been to an investor's benefit. Independent analysis suggests that the adage is accurate only 39% of the time. Quite rightly, a lot of clients are asking us at the moment what effect they think that the election will have on their investments. So the following chart on the next slide is an analysis of what happens to markets after the general election, and here we can see that the fortunes are mixed. There is a belief that a Labour Party will have a positive impact on markets, although this was not true at the beginning of 2000 when exceptional market circumstances, taking account of September the 11th, Gulf War, etc., had a very negative impact on markets. So these charts cover the last 4 general elections. The midpoint along the bottom line in each chart represents May. As I said earlier, they do give mixed fortunes, and these only serve to illustrate that it's not a slam dunk as to what an investor should do at this time. It's also worth remembering that events of the past offer no certainty as to events of the future. So what action should we take? On balance, I'm not minded to recommend to any of our clients that we take any specific risk with regard to exiting the investment arena and attempting to re-enter at some lower point between now and September. I am, however, mindful that we should be prepared for some volatility. Are the markets too high? The great British Reserve that exists always exercises caution at times when things are going very well. Markets have reached their all-time high, and this results in oft-asked questions. Can they go any higher, or are they overvalued? At the beginning of the century, when the FTSE first flirted with the 7,000 level, the market was operating at 30 times earnings. It's currently operating at half of that level, which suggests that these valuations are of better quality. When considering whether or not the market is fully grown, we need to consider the outlook of the general economy, and of course, this is improving. Couple this with the fact that investors are eager to get their money to work and that cash returns offer no real prospect, then logic suggests that the markets are the correct place to be. Of course, our continued recommendation would be to hold a range of assets that blend to meet an investor's own appetite toward investment risk. We always invite our clients to discuss with us the risk position of their portfolios to ensure that it continues to meet their own appetite for risk and their investment needs. Borrowers and savers alike are worried about interest rates, although obviously for different reasons. And although we are repeatedly told that interest rates will be going up in the near future, data that is being released on a regular basis supports an opposite view. We cannot, of course, presume that interest rates will stay at this very low level for the long term. And should rate rises start being fed into markets, it is unlikely that there will be any immediacy in newfound attractiveness in terms of cash savings accounts. However, we do think that if interest rates start moving upwards, then certain investment areas will come under pressure. The focus here is the gilt market and the fixed interest market, and we use these areas inside a client's investment portfolio to provide some of the lower risk exposure that is necessary inside a portfolio, which in turn helps with creating a less volatile investment solution. These investment areas are of course of particular interest to the lower risk investor. We have recently been researching areas that we could move low risk funds into and anticipate being in touch with clients in the near future with regard to a remodeling of portfolios so that the low risk element of the portfolio can be suitably adjusted. Obviously, in this regard, we will contact each client individually. It may be useful to give a quick consideration to markets generally. In the UK, the FTSE has reached its new heights. Volatility will almost undoubtedly creep in as the uncertainty of the election draws closer. In the United States, the question here remains as to when the US Federal Reserve will begin to increase their interest rates. Moving over to Europe, the European equity markets have had a very strong start to the year, and the main reason behind this is the expansion of quantitative easing by the European Central Bank. This lifted investor sentiment in the same way it did when the Federal Reserve increased QE back in 2009. Now considering emerging markets, for most of the first quarter, global emerging markets kept pace with developed markets, yet this generality masks the varied performance contained within the data. For instance, the market in China has lacked somewhat, whereas the market in India has moved forward on the basis of policymaker reforms and increased investor optimism. The oil price continues to vary and has shown some recovery from the low points in January, moving up from around $49 a barrel to around $55 a barrel. The likelihood of a move back toward the $100 per barrel price seems unlikely over the medium term, and as a consequence of this, many energy stocks have struggled to perform. This places pressure on natural resources funds, but is something that in all likelihood will reverse as soon as the oil price starts to move forward, which of course it can do with some vigour. In summary, and to close off this investment review, the closing thoughts now focus on the election. Should we take any action? On balance, we think not. We position ourselves as long-term investors and must anticipate short-term volatility. Volatility can be created by many external factors, as we have seen in the recent past, for instance, world conflict or world markets being spooked by the troubles in Greece. It has been the case in the past that this volatility has moved away and investments have returned to a more normal pattern of behaviour. Should we sell in May and go away? The analysis would suggest that a long-term investor who does not seek to speculate on a high-risk approach should not do this. It fundamentally amounts to a bet. We do remain a little concerned about the long-term prospect of some of the low-risk investment elements inside our portfolios. These low-risk investment areas have attracted significant investment on an almost disproportional basis as low-risk investors seek to increase returns as they move away from cash. Our concern here is that an exodus from these markets could see a significant reduction in the capital values and so some atypical volatility in the low-risk investment arena. It is for this reason that we have been researching a new low-risk investment solution, and we anticipate making recommendations during 2015. Well, that brings this investment review to a close. As usual, all of our contact details appear on the last slide. You are of course welcome to contact us at any point and with regard to any matter using these contact details, and we thank you very much for listening.